Greetings. I'd like to give you a brief update on gold and why I feel that is eventually going to break through this current trading range and go substantially higher. It's been frustrating waiting, but I think it's going to be justified by conditions. First of all, here is a chart of the cash price of gold going back to 2012. And as you can see, there have been three different times over the last 3 years where it's moved up to that 2048 level and been rebuffed. But we think it's just a matter of time before it breaks out of here, especially once the Federal Reserve is forced to reverse its policies, which we think we're getting close to. One of the reasons that we think is a high probability that gold's going much higher is how out of control the federal government finances the budget is and how out of control the level of deficit spending. Since 2010, the deficit has been increasing at almost 8.5% compounded a year. This is an impossible rate of increase given the growth of the economy is more in the 3.5% rate over time, and debt cannot keep increasing at this rate relative to the economic growth rate. We are facing a serious treasury supply of new debt in the next year. The deficit could be anywhere from 2 to 3.5 trillion, depending upon whether we have a recession or not. We also could have $2 to $3 trillion of foreign government selling, foreign individuals selling because of what's been going on. And they've been in aggressive sell mode for the last year. Also, the federal government's going to need to roll over 5 trillion of maturing debt. And so this is almost like a tsunami of debt coming at investors. The private sector is not going to be able to handle it. It's unlikely that foreigners are going to be buying it because they've been net sellers. And therefore, the buying is going to have to be done by the Federal Reserve, and which will force them to change their tight money policy and begin to acquire debt. We look at what's happened with foreign ownership of treasuries. You can see that since 2021, foreign governments have been net sellers of treasuries. Prior to 2014, they were significant buyers of it. Then it plateaued, and since 2021, they've become aggressive sellers, which I think is a function of the rising inflation and also the realization of how out of control the U.S. budget deficit is. At the same time, global governments have been buying gold, and they started buying gold again back in 2009 after the last financial crisis. And they've actually started to accelerate that buying in the last couple of years. And we think that this is an event that's likely to continue, particularly because of what's going on in the international monetary sphere. We think there's profound change that's occurring. The usage of the dollar in bilateral trade is likely to decline because there's a great deal of movement by the Chinese and others to try and remove the dollar as the only international currency. And they seem to be successful in pushing that through. So what we're seeing happening is the dollar, while it'll still be a reserve currency, it's not going to be used as much in bilateral trade by many countries. Currencies, particularly those currencies of BRICS countries, are going to be using their own local currency in bilateral trade. And I'd like to just give you one example. India uses the rupee. The rupee can now be used to buy oil from Russia and Abu Dhabi because those two countries have agreed to sell oil for rupees. Russia and Abu Dhabi, when they receive the rupees, are likely to turn around and buy significant amounts of Indian goods and services. However, they're unlikely to be able to spend the entire amount that they've received. Therefore, what they're likely to do with their excess rupees, because I don't think they're going to hold them in reserve, they're going to convert them to gold. And many countries are going to be doing the same thing. The Chinese have encouraged people that countries that are buying Chinese goods and receive or buying China buying goods from other countries and they receive excess yuan, they've been encouraged to exchange that for gold. So by default, gold is likely to become the primary international reserve currency because of all these disparate events that are taking place. So now if we look at global central banks and the quantity of percentage of gold that they own, historically they held as on average 58% of their reserves in gold. Then they went through several decades of selling gold and buying U.S. treasuries because treasuries paid interest, and that ownership of gold hit its bottom in the early 2000s at around 10% of their total reserves. And now, since 2009, as they started to buy again, the percentage in gold has moved up to 17%. We think it's entirely possible that because of this bilateral trading that's taking place, that it could move up back up to that 58% level. If it did, governments in total would be buying 131,000 tons at current prices. There's only 209,000 tons of above ground gold in the world. And therefore, it's looking at the numbers, it looks like gold could be in short supply and prices are going to rise substantially. So we think that's a major event that's affecting the future price of gold. Now, to give you another example of how undervalued gold is, this is a ratio chart of the U.S. Treasury gold holdings at market as a percent of total Federal Reserve monetary base. Prior to 1934, when Roosevelt called in all the gold, the Federal Reserve was required to have a minimum of 40% of their monetary base in gold. And since that time, it's declined substantially because we're off the gold standard. But on two different occasions in the 30s and then again in 1980, when there was financial turmoil, gold prices went up substantially relative to the monetary base and went well above 100% of the total value of the monetary base. If gold were to go back to the 40% level, it would have to go to a price of around $8,400 an ounce. If it were to go above 100%, it would have to rise over $21,000 an ounce. Whether or not that's going to happen, we don't know, but it certainly has happened in the past, and it could happen again. We think that there's a great deal of upside relative to the potential downside. So looking at the long-term chart of gold since 1967, around the time that we stopped keeping the price at $35 an ounce, there have been two major moves up in gold, and we think we're in the early stages of a third move that could be even bigger than these first two, given what's happened monetarily. Gold stocks, gold mining companies, historically have moved significantly. When the price of gold goes up, mining stocks can go up 3, 5, 10 times as much as the price of gold. Given how undervalued gold stocks are to the current price of gold, we think it's entirely possible that we're going to see a major percentage move in gold mining companies, even greater than what's happening in gold. So if any of this is of interest or you're confused about anything I've talked about, please feel free to give me a call at 203-554-4003. Look forward to speaking with you. Thank you.